Let's talk about growth. We all think of it as the lifeblood of a company, right? The ultimate sign of success. But what if I told you that the very act of growing could be the single most destructive thing a company does? That's the paradox we're going to unravel today. And it all starts with one single crucial question.
You know, this question really gets to the heart of valuation. It's the reason two people can look at the exact same growing company and see completely different futures. One sees immense value and the other sees a slow-motion collapse. The answer isn't about if a company is growing, but how it's funding that growth.
So, to really understand how growth works, we first need to talk about its fuel. And that fuel is something called the reinvestment rate. This is the core idea that connects the profits a company makes today to the growth it's hoping for tomorrow.
Okay, so what is it exactly? Well, the precision here is absolutely critical. We're not talking about just any profit. We're looking at after-tax, operating profits, the pure earnings from the core business. The reinvestment rate tells us exactly what slice of that core profit is being plowed right back into the company, whether it's buying new equipment or just funding the day-to-day cash needs of a bigger operation. It's literally the company's investment in itself.
Now, you might have heard of the retention ratio, but this is a much more fundamental view. The retention ratio kind of just looks at what's left for shareholders after everything's done. The reinvestment rate, though, it looks deeper. It assesses the entire enterprise, the whole engine, to answer a much more important question. How much cash does this business really consume just to keep growing?
All right, so a company reinvests its profits. Then what? This is where we get to the fundamental laws that decide whether that decision creates a fortune or just digs a massive financial hole. Believe me, there are rules to this game.
And here it is, the engine itself. Your growth rate, G, is simply the product of two things: how much you reinvest, your RR, and how well you reinvest it, which is your return on invested capital, or ROIC. You just can't have one without the other. Reinvesting a ton of money with terrible returns? That gets you nowhere fast. It's a simple formula, but it's incredibly powerful.
But wait, just generating a return isn't enough. Not even close. Here is the ultimate test for creating value. The return you generate on your capital, your ROIC, has to be greater than your weighted average cost of capital, your WACC. Just think of WACC as the minimum acceptable return that your investors are demanding. If you can't clear that hurdle, you are failing them with every single dollar you reinvest.
Let's make this really tangible with something I call the $1 test. Just imagine management takes $1 of profit, a dollar that really belongs to the shareholders. They invest it. That dollar has to generate a stream of future cash. Now, when you pull all those future cash flows back to today's value, is it worth more than the dollar they started with? If it is, boom, they've created value. If it's not, they've destroyed it. It's that simple, and it's that brutal.
This matrix basically lays out the three possible fates of that reinvested dollar. If your return is higher than your cost of capital, you create value. If it's below, you destroy it. But I want you to look at that middle category, value neutral. This is the subtle trap of poor growth, where companies get bigger without actually getting any richer. They're just consuming capital to tread water.
And this chart just makes the cost of being inefficient painfully clear. Look at this. Both of these firms want to grow by 5%. The high-return company on the left, it only has to reinvest 17 cents of every dollar of profit, which leaves a whopping 83 cents as free cash flow. The low-return firm, though, has to reinvest 50 cents, leaving only 50 cents free. Think about that. To get the same growth, it sacrifices nearly 3 times as much cash as its efficient competitor. That's the efficiency premium right there in front of you.
So, we have the clean math, but you know, the real world is a lot messier. The cost of growth is often hidden, lurking in ideas that don't always show up neatly on a spreadsheet.
And this gets us to the true hidden expense, opportunity cost. Every single time a company invests in a project that earns, say, 5% when its cost of capital is 10%, the real cost isn't just the money spent. It's the lost benefit of not giving that capital back to shareholders who could have invested it somewhere else to get that 10% return.
And there's another challenge. It's almost a law of nature in business. Success breeds competition. High returns act like a magnet, drawing in rivals who chip away at your profitability. This natural erosion is called the fade rate. And what it means is that a chunk of your reinvestment isn't even for growth. It's defensive capital, spent just to hold your ground.
Okay, so let's ground all this theory in reality. The history of business is just littered with stories of companies that either mastered these principles or were completely broken by them.
First up, let's look at General Electric. For decades, it was an absolute behemoth of industry, constantly reinvesting massive amounts of capital. And the market trusted them to do it wisely.
But GE's enormous scale became its greatest weakness. When its return on capital started to slip, getting closer and closer to its cost of capital, the sheer volume of their reinvestment was staggering. It meant billions upon billions of dollars were being deployed into growth that was either value neutral or, even worse, value destructive. Scale became an amplifier of inefficiency.
Next, the classic cautionary tale of Borders bookstores. This is a perfect example of what happens when you pour good money into a bad strategy. And therein lies a critical lesson. Borders kept spending money to maintain and update its physical stores. From a narrow accounting point of view, that looked like necessary reinvestment. But strategically, they were pouring capital into a business model that was becoming obsolete. No amount of financial discipline can save a company that's reinvesting in yesterday's assets. But it's not all doom and gloom. Let's look at Walmart. They faced their own existential threat from e-commerce, but responded with incredible capital discipline.
And this is just a brilliant illustration of how to do it right. Walmart didn't just cut costs to boost quarterly profits. No, they cut costs to build a war chest. They then took that capital and reinvested it aggressively into building their digital and omni-channel future. Every single dollar of reinvestment had a clear strategic purpose: build the Walmart of tomorrow. So this brings us to the final mandate. If you're an investor, an analyst, or a leader, what does all this mean for you? How do you actually monitor this critical function of capital allocation?
Here's your discipline. First, you have to constantly, and I mean constantly, watch the spread between return and cost. Second, you must question the quality of the profits funding this growth. Is it real cash or just some accounting trick? Third, you have to understand the competitive landscape and really think about how long those high returns can possibly last. And finally, you always have to ask the ultimate strategic question: is this investment creating a bigger future, or is it just defending the present?
You know, in the end, this whole analysis elevates the discussion from simple mechanics to the very essence of corporate leadership and good judgment.
The numbers and the formulas, they are absolutely essential tools, but they only tell you part of the story. They can tell you what happened, but they can't tell you why. Ultimately, a company's ability to grow and create lasting value, it isn't found in a model. It's found in the wisdom and the discipline of its leaders to know not only how to grow, but more importantly, to know when not to.